All right, so you're someone new to trading, you're a beginner, and you want to trade futures. And you are kind of looking at a variety of different strategies. You probably went from one thing to the next over a series of months and possibly years. And you found a little consistency, which allows you to make good money trading the future markets. I'm going to show you today the strategy which I have unfolded and shared and revealed across this channel, YouTube, on multiple occasions, and many videos. And the reason why I keep rehashing and talk about the strategy, because it works, and strategies that are effective, that do work to where you can become profitable if you take the time really to understand and break the strategy down as a whole, back tested it, okay, then really test it in demo and simulation to see how consistent you can be and become profitable using that strategy. Then that's when you're going to know that you're onto something that's going to lead you in the right direction. But before I really get started into showing you, because I want to run through a quick demand setup and a supply setup for all those out there that are my supply and demand style traders that are looking, for the aggressive areas where the market is either pushing higher or pushing lower. I'm going to cover both ends for you today and just show you the strategy, breaking things down, just so that you can, and simplify them so you can understand. All right. So please pay attention, pay close attention as I talk about these key details, these specifics to what I am looking for. All right. It's a freebie again for anyone out there that is really struggling and trying to find something that is consistent. But I'm going to tell you, you've got to learn market structure. That's number one. And number two, be patient enough to wait for the setups to unfold for you. All right. Lots of people are moving down, scaling down to these lower base charts and trying to trade specifically from them 100% when they're not following the overall direction of the market. So you're either going to get chopped up, you're going to get stopped out, and you're going to lose money. So this is why I talk about taking trades in the direction of the market. And if you are trading from lower base charts, you're going to notice the lower that you start to scale down to, you're going to start to see a lot of noise and activity as far as price action, and you want to weed that stuff out, okay? So pay attention. I'm going to start with my higher base 120 range zone. This is a demand zone from November the 6th, just a few days ago. But what I want you to pay close attention to is what direction do we see the market moving? It was actually moving to the upside. All you have to do is really follow with your own eyes and be able to see these type things where the market is making higher highs, okay, as it pushes higher, seeing this activity to the upside and identifying the structure breaks to the upside. As long as we're breaking structure higher and the market is making higher highs and higher lows, then we are simply, moving in the direction to the upside. And all you want to be able to do at that point is look for opportunities on key pullbacks to these aggressive areas of selling, or in this case here, buying. Okay, so let me do away with this right quick, these lines, so we can talk about the actual zone on which I'm referencing right here. So we can see the market still channeling to the upside. I mean, you can clearly see this with your eyes. So the market goes up, pulls back, breaks some structure here, pushes up, pulls back, and it breaks, breaks above this high here. So that's a structure break to the upside there. So when it pulls back right here, this right here is a demand zone right here. Right here. Now, the difference of this area here, okay, is that it is actually a low probability zone. I'm going to show you the difference right quick. Low probability is where you have no gap resting back at the actual zone right here. But there is still a gap inside the zone. If I mark this off from, this is how I draw the supply, the demand zone right here, a small gap from this candle, the bullish candle here, to the second candle, third candle. In between there on the body of the second candle, there's still a small gap back at the zone. So pay attention to things like that as well. Typically, this would be a low probability setup because the market came back on that third candle, break to the upside, and then the wick of it came back and tapped in or touched the top end, the wick of that bearish candle here. But there is a smaller gap or still a gap resting on the inside of the zone, in this case here, in which the market can fill in or test. So it's an imbalance in a sense to where the market can test. So I'm still interested in setups like this because there is still a gap on the inside of the zone. All right. So at that case there, or in this instance, I'm interested, still a gap there. So we're looking for the market to pull back. The direction we got to right to the upside is breaking structure, okay? And sometimes what you'll see is, say for example, right here, I'll show you. Let's see. Where there may not be an actual like gap back on the inside of the actual zone, okay? So you have a difference where there may be a gap at the top end. Say for example, this bullish candle, right? This bearish candle right here. This next candle is bullish. It may come up and match the top end of that last down bearish candle. So, and then you may get another candle, a bullish candle, or you will get another candle, a bullish candle that breaks above it. So there's just a gap back to the actual top end of the bearish candle. Depending on how this candle here will actually close, it will determine is there going to be a gap on the inside of the zone, as well as possibly it's a gap back at the zone. So there's a difference there, meaning like right here, you see how this candle right here closed, this bullish candle pushed up. All right, so it left a gap between this candle here and this next bullish candle that closed right here. All right, and the third one right here, there's a small gap back down on the body of that second candle. The gap which I'm talking about most time is the gap between the last down bearish candle, all right, and then the candle that breaks above that bearish candle, that bullish candle that breaks above that bearish candle, and then you get a third candle that forms above. Say for example, is there a gap between the top end of the wick of that bearish candle and that third candle that closes? Is there a gap there? Sometimes you'll have both a gap there and maybe a gap on side of the zone as well off that bullish candle that forms right here. So it all depends on how that bullish candle closes. If it closes to the top end of that bearish candle, and then you get a close of with a bullish candle that closes above that bearish candle above, you may just get a gap back down to the zone. Sometimes you may have two, one down to the zone and then one on the inside formed off of that bullish candle sitting on the inside. So, for example, let's see here, like right here, with this candle here closed here, first candle, second candle, and then there's a third candle that closed above all this right here, and it closed above that last down bearish candle. There's a small gap, in between here and even here, right? Between the body of this bullish candle right here, but it was also a gap back down to the actual zone itself, where the market closed above that bearish candle. So, lots of times you're going to see where the market may come back and just tap the zone itself, where there's a gap back at the actual zone, and then push higher. And sometimes it may come a little deeper if there's a gap back on the inside of the zone, and then tap that and then push higher. So we're trading based off the rejection back to the actual zone. So I'm looking for, is there a gap resting back at the zone first? And if it rejects off of that gap back at the zone, meaning the candle that closed above the last down bearish candle, okay, and then we got a gap and it comes back and fills that void, I'm looking for that first, okay? And if I get rejection off my lower base chart, then I'm looking for the opportunity to go, either short or long. In this case here, I'm going long. This was a structural break to the upside, which increased the probability as well, because I like to see where there's a break of structure form first, then meaning the market broke structure and then left a valid demand zone. So anyways, the market does come back to this zone here. This is still a valid zone, okay? Even though if we're trading it based off of the gap back to the zone, then it's actually low probability. But pay close attention to that there is a small gap resting on the inside of the zone from this candle, and this candle that formed. The first one that pushed higher, the second one that closed, okay? And we're looking at the gap in between the first candle and the third candle, which is the body on the second candle right here. There is still a very small gap on the inside of the zone. So the market came back there and filled that gap in. And if we go down to the lower base chart, and hopefully you guys understand what I'm saying. If we look at the lower base chart, this is the chart in which all the action comes from, and I'm trading the NASDAQ futures, okay? The NQ, so this is the strategy surrounding, that particular market. This retracement or pullback is that same retracement we see off the higher base chart here. It comes back, taps the zone. Once it taps the higher base zone, which is that bigger box, I'm looking to see if there is a smaller base demand zone resting on the inside. And there is right here. And there's an actual, see, if I blow this up, you can see what I was talking about the that last down bearish candle, that bullish candle that formed here. It came up, touched the top end, pretty much, head to head on the bullish candle there, and that bearish candle met up at the top end. Okay, meaning and then that next candle that closed above, it only left a gap back to the actual zone. Now there's a small gap on the inside of the zone here from that first candle, the second candle, and the third candle. So on that second candle that formed on that bullish candle, there's still a gap resting here. If you pay close attention, you'll see. Let me squeeze this in. what they did is when they retraced, they came back and they filled it all the way back in, coming back down to the gap on the inside of the zone too. Sometimes, like I said though, they'll come down, just fill the gap from that top end of that bearish candle to the gap that's left on, from this candle here and that next candle that closed. So basically, in this case here, it was 1, 2, third candle closed above that last down bearish candle. There's a fourth candle that formed and left a gap in between the top end of the wick of that bearish candle and the body on this candle here that closed above the bearish candle. So with that gap resting right there, sometimes they'll come back, test it right there to the top end of that bearish candle, close that gap in, and then go to the upside. And then you can still have a gap resting on the inside of the zone, which they at some point may come back down to. So we were trading based off the rejection, but in this case here, they came down, they filled the gap back all the way into the inside of the zone, filling the gap filling the gap back down to the zone and the gap on the inside of the zone, and they rejected it. Gave us confirmation to go long. The confirmation I'm looking is on the break of the candle and close to go long. So you can go in aggressive on the candle that closes. The next candle that starts to break, you can go in at 20,697 or 98. But I always talk about looking for the break and close of the candle above, which will probably pretty much be here at 20,703. And that's more conservative to actually go long right there. The question always is where to take it back up to. Well, if you look, I'm back on the higher base chart. This is the retracement. There are gaps that need to be filled back in between this candle, this candle, this candle off the body of the second candle. So that's got to be filled there, especially right here. This candle from this candle to this candle, and then we got some sideways action here. Even though we get a closure to the downside on this next candle, it pulled back, but then we got a down candle right here. So then you got a gap from the top end from this candle here onto on the body of the second candle, so the gap in between right here. So there's a couple gaps that need to be filled back to the upside, and what you can aim for back to the upside. Typically I'm aiming for the first 20-25 points on the NASDAQ futures, but you want to be mindful to see where could it stop at above. Are there gaps that we're going to aim for? Yes. If so, then you can aim for those type areas. Is there liquidity resting above in which the market may try to take out? In this case here, there's really no there's multiple tops or double highs, double tops at the top here forming an area of liquidity. Liquidity is typically formed when you have multiple wicks sitting at the top above or multiple wicks below. So they'll try to, after making, say, for example, if this pushed up here and then we got a double top resting right here and it wicked, we got multiple wicks here, and then it came down, tested its demand zone, more likely they're going to want to take out the top end here and run that area of liquidity at the upside. I'm not saying above this area is not liquidity, but it is. It's just that liquidity is more evident when you have multiple wicks where the market's rejecting. Made a high here, came back, made a high here, didn't break above, it came back, okay? So we got double tops or triple tops, and then it hits an area of, in this case here, demand, rejects it, and then boom to the upside and takes out an area of liquidity. So I'm aiming for the gaps, liquidity. I'm looking for all those type things, okay, to the upside. Now, looking at the area of supply, it's just in reverse of. I talked about this on the last video or two, where this was the market breaking below this area structure, breaking below this area structure. Again, I talk about market structure and paying close attention to it to determine which way to trade. In this case here, the market is showing some some bearish sentiment to the downside, and we have this supply zone resting right here, aggressive selling back to the downside. There's a gap in between. See that last bullish candle on the pullback right here? The candle here closed above that bullish candle right here, okay? So it left a gap in between the candle that closed below and the next candle that formed right here, the gap in between right here from the bottom end of the bullish candle to the top end of this bearish candle. There's a nice gap right there. So the market comes back, fills the gap back at the zone, but there's also a small little gap inside the zone from the bearish candle here, this second candle and third candle back up to the inside at the bottom end of the bearish candle right here. So just, basically there's a gap back to the zone, which I talk about. If you get the rejection, you can look for the opportunity. But pay attention to the gap that is resting on the inside of the zone too, because sometimes they'll test that or push a little deeper into the zone to test that just as well. As you can see here, they filled all gaps coming back to the upside. This is a demand setup. Not demand, supply. Supply setup. Supply, we're looking for shorts. Demands, we're looking for longs. Supply setup back to the zone here. And then if we move down to the lower base chart, you can simply see, I'm going to move over so we can look at it and see. Where's that zone at? Right here. Okay, there's also a supply zone, a smaller 24 range supply zone. So this is the larger zone is the 120 range zone that I have marked up. We always mark up the higher base chart first, then we mark up the lower base chart. The market pulls back, taps into the higher base zone. We look to see and identify, is there a smaller base zone on the inside of our 24 range? I trade range based charts. There is aggressive selling, supply area here that needs to be filled, multiple gaps back to the upside. Taps it, go short. Once it taps it, you look down. Once it taps it and we get the rejection, the break and close of the candle, you look to your left and see, are there gaps that need to be filled? Yes, there's gaps that need to be filled back down, but you also have a demand zone resting down here at the bottom of the 24-hour, which you can also what am I trying to say here? Target just as well. Okay, so you take the trade, the break and close of the candle, it fills the gaps in right here, right here, right here, back down here, and comes all the way back down to the demand zone right here, and what you can look to exit your trade on. So if you got into the trade, say aggressively here at 226, then you can take it on back down here to fill in back down to the demand zone at 203, or get in here at 221 and take it back down here to 203. Okay, picking yourself up a nice amount of profit there, and the market keeps running. This is how you make good money trading the NASDAQ futures, but it's all about multiple chart confluence, looking for demand setup or supply to supply setup. Okay, marking the higher base chart, lower base chart. That's how we do it. Okay, but it all comes into play the more patient you are and waiting for these great setups. That's all I want to show. Okay, this is what I do on the NASDAQ. All right, you can do the same thing across any particular market. It's just that you may want to kind of play with is find out where you can find a middle ground at in reference to the higher base and lower base chart. Like on the ES, I'll trade the 60 and the 60 range and the 12 range. All right, and then you may, depending on the market, I'll trade the 120 and the 24 the same way I trade on the NASDAQ, or maybe the Dow just as well. It just depends on the market, how thin or how thick the markets move. Okay, how much volume is there? The NASDAQ is a very thin market, and it has a lot of, there's volume there, but it has a lot of movement just as well. So I have to bump it up a little higher is what I'm trying to say. So anyways, I appreciate everyone that tuned in to the videos. I hope everyone has or is enjoying their weekend just as well. Today is Monday, of course. It's Veterans Day. It's a bank holiday. But outside of that, I just want to share this with you because I like to push out and talk about the strategy. Just pump it out there, pump it out there, pump it out there so people can understand the way that I actually trade, not forcing anyone's hands, but this is how I personally do it. If you want more insight or in-depth information surrounding the strategy, where you can see me actually taking trade setups and I break those setups down, there's a link down in the description portion of the video where it says become an elite member. It's only $6.99 a month. Okay, really, I mean, a lot of people spend more than that on the price of a cup of coffee or for breakfast or lunch sandwich, and you do that daily. We're talking about from a monthly standpoint, $6.99, and you get access to tons of trade breakdown videos where I walk you through trade setup after trade setup after trade setup. You also get the video playlist, and you also receive a great video that I cover on market structure. All right, so anyone interested, the link is down in the description portion of the video. For everyone out there that is currently an elite member, I appreciate you for your efforts. For one, leaving comments and DMing me and say, Mike, those elite videos are very powerful. Those elite videos have changed the way you see things and how you trade, and a lot of you are successful and profiting, making money today. I definitely take my hat off to you guys, and I appreciate all your support here on the channel by supporting me as a content creator, because that's what you're doing, and that's what I give back as a perk or reward for all those that become an elite member, is that video content. So if you're interested, scroll down below, look in the description portion. Right below the first link is the Discord. The second one, click on it. Once you click on that link that says become an elite member, there'll be two tiers that'll pop up. One, or the second one's the one you want to choose, what you'll see an amount there for $6.99, and that's for a whole month. Okay, for a whole month. Once you subscribe to that, then you have direct access to all that additional video content. But outside of that, appreciate everyone. If you're not a current subscriber, please take the time to sub by clicking on the subscribe button. Make sure to turn your post notifications on so you don't miss any of the uploads. And last but not least, please do me the biggest favor. Click on that like button right now, that thumbs up button. I greatly appreciate it. It helps the channel out to get the information, video content like this out to other individuals that are currently seeking a great strategy in which they can, change the game for themselves, all right, and start becoming profitable. But that's all I have. Take care. See everyone in the next one.